I've had several requests to do a video that talks about some of the renewable infrastructure companies that we could invest into in the UK. And today I'm going to have a quick look at two of the FTSE 250 companies that you could get your hands on at a good deal at the moment. I'm going to talk through a lot of different financial metrics of these two companies, and the two companies we're going to talk about are Greencoat UK Wind, known by the ticker symbol of UKW, and then the Renewable Infrastructure Group, and known by ticker symbol of TRIG. These two companies are investment trusts, and investment trusts are slightly different to the open-ended investment companies that most of you probably have invested into, where you can continue to keep buying in to an OIC and they will just end up, the number of shares literally just keep increasing and the value of the fund just keeps increasing as well. Whereas the investment trust has a set number of shares. You also have the ability for an investment trust to use what is called gearing, which is looking at borrowing, and they can then buy in additional assets and then hopefully drive the price of the investment trust up. And that is basically leveraging that debt that they have. That comes with a risk. If you have too much gearing, too much leverage, you could end up, if prices crash, you end up holding an awful lot of debt that you cannot manage to deal with. They can also hold back 15% of their earnings, and you are looking at that 15% helping them through those slightly leaner years, slightly leaner times, where they can continue to keep growing their dividends. Let's jump in and have a quick look at lots of different metrics on both TRIG and UKW. So you've got TRIG is investing into a broader range because they are looking at onshore wind, offshore wind. They're also looking at solar photovoltaic panels, solar PV panels, and also flexible capability. They are not just constrained to the UK, but also branch out into Europe as well. So looking at Spain, Germany, France, and Sweden for some of assets. And you can see on this slide basically where that is broken down. If we then have a look at UK Wind, its place of activity is given away by its name. So it is basically focused on 49 wind farms within the UK, but you are looking at England, Scotland making up the majority of the wind farms. And if you think about where they are, the majority are down the east coast of the UK. If you're getting some value from this content, I'd love it if you could think of subscribing and hit the like button. If we have a look at the market cap, TRIG is slightly smaller, just at about that 2.4 billion mark, and you've got UK Wind just coming in under the 3 billion market cap. If we have a look at how have these two companies been doing over the last year, you are looking at they are both down quite substantially, and you can see on this chart how much they are actually down. They are both trading down close towards their 52-week lows, so potentially there is some value in both of these companies. They are both paying a very similar dividend yield. You have UK Wind just coming in slightly better at that 7.52 as opposed to TRIG at 7.34%. If we then have a look at what the dividend growth rate is looking at, and if you have a think about it, what you basically want is you want the dividends growing at least in line with inflation so that you are getting a net gain over time. This happens with UKW, where you are looking at it coming in at about 8.15%, and this is one of the things that I really like about Greencoat UK Wind. They have set in their prospectus, you can see they are looking at matching RPI, so the retail price index, every year for their dividend growth, and that's where holding back 15% of their earnings really does help them do this. If we have a look at TRIG's dividend growth isn't that high. It's coming in at about 2.01% dividend growth rate over the past 5 years, so not quite as good. And then another thing that we need to have a look at is the payout ratio. Trig is coming out reasonably high on this one. It's coming out at 94%, but that I think is potentially helped by slightly lower earnings, but the fact that they can hold on to that 15% to help them through the slightly leaner times. You're then looking at UKW coming in at 69%, still running a little bit high, but if we think about it, they could be paying up to 85% quite easily and not running into any issues on that side of things. Let's have a quick look at what does value look like in these two stocks. First of all, we'll have a look at the price to earnings ratio. PE for Trig is reasonably high. It's running above the average for the FTSE 100 and the FTSE 250, coming in at 19.49. And then you're looking at UKW, really is looking like it's at a bit of value, where it's coming in at 6.3 on that price to earnings ratio. If we then have a look at the net asset value, first of all, what is the net asset value? The net asset value, as you can see in this equation, what's the company worth and what are the liabilities that they have set against that. If we're then having a look at the net asset value per share, we then take that net asset value and divide that by the number of shares outstanding, and that will give you the NAV per share. If we have a quick look at what is the NAV for Trig, it is looking at the NAV per share should be running at 132.5. Currently, it is running quite a bit below that, and it is showing that there is a discount potentially in there against net asset value of about 26.5%. If we then take a look at what's the NAV for UK Wind, you're looking at 162.11, and once again this is still running at a discount, and that's coming in at just over 20%. So both of them are undervalued compared to assets minus liabilities of the companies. So potentially there is opportunity of bagging yourself a bargain here, but do go away, do all your due diligence. Great website to go and have a look at is the Association of Investment Companies, and if you have a look down below, I will drop a link into there. So it'll give you lots of information. I'll give you a quick bit of overview, some of the performance of these companies, portfolios, ESG, dividends, and so much more. You can also go in, have a look at some of the announcements that they have made, have a look at the management, and management is so important. If we think back to what Warren Buffett says, is have a look at the people that are managing the companies. If you trust them to run the business well, you are on to a winner. And with investment trusts, you find that having a stable chair in there and a management team is really, really important. You can see as people come to retirement, you potentially see the company's price plummet, because nobody knows what's going to happen with the new team that comes in to run the company. We did have a quick talk about what gearing was, and that is basically taking loans or taking debt to go buy other assets and then hopefully using that to create more money for the company. If we have a look at the gearing side of things for Trig, it is really low, coming in at about 3%, and you've got UK Wind coming in, a little bit more gearing being used, but this is normal with investment trusts. It is one of those differentiations that they have from an open-ended investment company, and it's sat at about 19%. It basically does say within its prospectus that they would be looking to keep that at under 40%. If we then have a look at debt to equity, Trig not carrying any debt at the moment, and then looking at UKW coming in at about 36%. So buying into all of this, what does it actually cost? So there is an ongoing charge for both of these funds, and you have the OCR for Trig coming in at about 1.04%, and you're looking at UK Wind being 0.93. So that is your management cost for the fund manager. And while I say I don't like paying additional amounts of money, so if you think about all the ETFs that I invest into, I'm trying to keep that as low as possible. There is the charge for the investment trusts, but weigh that against the fact that you are getting a 7.5% dividend for both of these companies. I think there is a bit of a give and take on that. And also you're looking at UK Wind, looking at increasing that dividend growth in line or better than the RPI. So what are my thoughts on these two companies? As I said, I invest into both of them. I've got 1,150 shares in Trig, and I've got about 1,000 in UK Wind at the moment. If the prices continue to stay down close to that 52-week low, I may potentially buy into a little bit more, but I want to make sure that I have got a balance within my overall portfolio, that I'm not too weighted towards the renewable sector, even though I do think there is going to be a need, particularly in the very near future, to start ramping up alternative sources of energy. So I am probably going to keep both of them, but I would love to hear whether or not you've got either of them within your portfolio, or do you think one or the other is potentially going to deliver slightly better? Why don't you go and have a look at this video where I do talk about some ETFs that you could invest into that also pick up a slice of these two companies if you don't want to go for them individually. Thanks very much for watching, and I will see you in the next one. Cheers, bye.